to kick it off, as I mentioned just now, we're talking about what is a myth, in my opinion, which is if you find a good deal, the money will come. And so this is something I certainly bought into heavily when I first started in the business. I figured, I was a very rational and logical person. I'm a numbers guy. So I just think through numbers. I think, well, if the deal has good numbers and the deal makes sense, well, then it shouldn't be hard to get investors for. You should just be able to raise the capital. But I learned through experience very quickly that that is not the case. You can have a good deal, and a good deal is subjective to it. It's not black and white. Numbers, even numbers aren't black and white. So, but in my experience, when you have a good deal, it doesn't necessarily mean you're going to automatically raise the capital. I think having a good deal or a better deal than not is certainly helpful to raise capital, but it's not going to solve your problem. If you have a money raising problem, you can't solve it with a good deal, which is very unfortunate. And it's something that, like I said, both my business partner and I, we believed in, and that was our focus. We focused on finding a good deal, and we really neglected raising capital. We put it on the back burner. We figured, we're real estate guys. Let's focus on what we like to do. Let's focus on the real estate, and the money will come. And through our first few deals, we struggled to raise the capital so much, and it really opened our eyes and taught us that we need to take a different approach. We realized that, and I think this is true for everybody, you need to take capital raising extremely seriously, and you need to have someone on your team who's going to focus the majority of their time on capital raising, and you have to build a process and a team. It can't be haphazard, and it can't be something that you just pray for. You just hope that it all works out. There has to be a system, and we've constantly evolved our system with every deal, and we're improving in different ways, and we're continuing to improve, and it's a big focus for us. And it all goes back to the first few deals that we did where we had good deals. Those deals have turned out to be good deals, but raising the money was very difficult. And then you fast forward to today, we're raising much more capital, and it's much easier. So that is it's an interesting experience. And I see Ronnie just joined. Thank you for joining. I'm sure you can contribute to this conversation pretty well as well, talking about capital raising and how a good deal can maybe help with raising capital, but it doesn't necessarily make it that much easier. At least that's what we've experienced. And observing other people in the industry, I think you could see that they, other people that have lots of experience, it almost doesn't really matter what the deal looks like because their investors are investing in them. They're investing in the sponsor, not the deal. So it's certainly not, oh, here's the good deal, and then now the capital comes. If it's a bad deal, the capital is not going to come. The goal of this business is to build up an investor base, a reputation, and relationships so that people are investing in you as a sponsor and not the deal. That doesn't mean you should go out and do bad deals, obviously, but I think that is the goal. And if you look out into the competitive landscape, you see people who are having tremendous success doing that. However, an interesting point to note is the institutional side of things. So in the institutional world, which, more sophisticated investors, professional investors who are doing this as a job, as full-time, whether it be family offices, private equity firms, opportunity funds, they do only invest in what they believe to be good deals. So they don't just build a relationship with you and say, okay, well, since we have a good relationship now, we'll invest in any of your deals. That's not the way they work. So it is very much so a relationship first model. As I mentioned earlier, numbers are the numbers, but even institutional investors, which are extremely numbers driven, they're not just going to crunch the numbers and say, oh, it's a good deal, we're going to invest. They are also human, and they need to build a human relationship. They need to build trust. They need to see track record, experience. They want to work with people that they like, basic basic relationship stuff. And then on top of that, the numbers have to make sense, and the deal structure and terms have to make sense, of course. So I think that's an interesting caveat about kind of the institutional side, where I would say, I mean, maybe some people have achieved this level of success and reputation, but I haven't really personally experienced or seen firsthand a company have a situation where they have such a strong relationship with an institutional partner that they'll just invest and not, they're investing in the sponsor, not really look at the deal. I could see that being the case. I could see a sponsor being able to get to that level, but I think in the institutional space is where it's still, you need to be great. You need to be great, and then the deal needs to be great, and then the money will come. Whereas I think on the retail side, it is certainly possible and the goal to build relationships with your investors where they are trusting you, the sponsor. And it's not because passive investors on the retail side are, they're not smart or they're not savvy, whatever it is. It's simply because that's the business model. They're not professional investors. They are trading. They're using their trust to save time, right? They don't have expertise in real estate investing, most likely. They don't do it full time. So they are trading away control of the deal and, intimate knowledge of the deal in order to be able to leverage their capital the best and save themselves time so that they can invest their capital while continue to focus on their main main source of income, right? It would be silly for them to take their eye off the ball, if their main driver of income, to then go and try to invest $50,000 the most optimally, right? That might make them an extra couple grand here and there, and it's certainly not worth their time when they can make tens of thousands more if they focus on their career. So that's why on the retail side, when investors are passively investing smaller amounts, it really does make sense for them to develop relationships with sponsors that they trust and then invest on a sponsor first basis rather than diligencing every single deal that comes through and underwriting every deal and spending hours on every deal when that's not the best use of their time. Whereas in the institutional side, right, a professional investor who does this full time, this is what they're set up to do, right? It might be a fund that has $500 million and they have a team of professionals that is tasked with investing this money. And that's why they have the time and the expertise to rigorously due diligence deals and, sift through lots of opportunity. So I'll take a pause here. We've got some good people now. I know some people have been joining over the last few minutes. So I'll take a pause here and just open it up to people if they want to add in their own perspective or just put questions in the chat, or you could simply unmute yourself and ask a question or provide some context, or if you want to guide the conversation in any direction, feel free to do so.
Hey, Rob, it's Whitney. Can you hear me?
Yep.
All right. So you talked a lot about, building those relationships before you have a deal. So, I mean, for you and your partner, what does that look like for you? What does that conversation look like? I mean, what do you, if you don't have the deal in front of you, what are you telling investors? How are you building those relationships? Yeah,
that's a good question. So it's funny because the best way to build relationships to, with investors and get them towards investing in a deal is by having a deal, right? So it's a chicken or the egg catch 22. And the best way to go about this is if you, like I said, I mean, it's not always possible, but the best way to go about it, if you can, is to have a deal as live as possible. It could be just a deal you're bidding on, so you don't have control over it, but it is definitely more preferable to have a deal that you do have control over. Might be maybe under LOI or under PSA, but it's not needed. Just having a deal to talk about is really valuable, and that's something I talk a lot about, because dealing, especially when you're talking about institutional investors, with retail investors, this is far less important. But if you're talking about more sophisticated investors, it's hard to talk abstractly with them because they're deal junkies like all of us. They want to do deals and they're motivated and paid for doing deals. So if you call them, email them, get in touch with them about a deal, well, that's exactly what they're looking for. And it's much easier to have a conversation and learn about what they're looking for, at the same time as sharing more about your strategy, about your team through the context of the deal. On the retail side, it's definitely a different process because it's like we discussed earlier, it's far more sponsor centric. You're building trust so that they can invest in you and whatever deal you have. So that was the big lesson we learned early on, and we flipped the script. Yeah, both my business partner and I were, I'd say, shy, not good salespeople, not interested in marketing, not passionate about it, and that was obviously a recipe for disaster. So we quickly realized that one of us had to step up, and it ended up being me that decided to step up and really lean heavily into thought leadership, marketing, sales. Uh, all those things are related, of course, but that's the direction that we knew we had to move in. And on the retail side, that's really the most powerful thing that you could do to establish a pipeline, because you don't want to have to be chasing investors, new investors, for every single deal. You want to be able to have a steady flow of investors coming your way. And the only way you can really do that is by building a funnel. And the top of the funnel is content, because if nobody hears about you, sees about you, then they have no opportunity to get more involved with you. So top of the funnel for different people. For some people, it looks like a podcast. For other people, it looks like a book or a newsletter. But there needs to be something at the top to get people exposed. And then for those that want to know more, there's a middle funnel where it might be something more interactive or more intimate. And then towards the bottom, there needs to be direct contact with, Zoom call, phone call, in-person meetings. And that is none of that this entire process, going back to your question, none of that requires a deal. You could do that way before a deal.
That makes sense. And so like, I don't know if you've done these numbers, but like, what's your conversion rate on like, who you capture in that entire funnel, right? And who's actually investing in your deals on average?
Yeah, this is something that we've been researching and working on recently, and it's something that actually we do a really bad job of. And I think it's because we are getting away with it. And so this is something that I intend to fix as soon as possible. And when I say get away with it, what I mean is we've been fortunate to have pretty good top of funnel where we're doing podcasts, we've got a book that has done well, and we post daily on LinkedIn. So the top of funnel is active, and we have a lot of reach. We've grown our email list substantially. And then at the bottom of our funnel, we're getting deals done, we're closing deals. So on the surface, if you zoom out, everything looks okay, but the middle of the funnel actually, as we've started to look into it, is very leaky. It's very bad. So our conversion rates are really low. We have, let's say, something like 10 people per week fill out our new investor form. And so what that means is maybe someone saw a post on LinkedIn, or maybe they've been following us for a while. They read our book, and then they decided to learn more by filling out a form on our website to become a new investor with us. So out of 10 people per week that fill out that form, maybe only 3 people sign up for a call. So we go from form to call, and we lose 70% of people, potentially more. Then from the call to invest, I would say we lose another maybe 60% of people. We're working on this data, but this is just kind of anecdotally what I'm recalling. So very leaky. In the end, it could be, if you're looking at out of 10 people that sign up, it maybe only 1 invests. And that's really bad, because that's a very hot lead. For someone to fill out a form and say, I'm an interested investor, only 1 of them to actually convert to an investor, that is very poor conversion. So I think that's a really interesting topic that we could dive into more, but does that answer your question?
Yeah. And I mean, it might not even be a bad conversion rate when you think about all the groups out there for them to invest in, the competition. It could very well be a good number. It's tough to tell. I just didn't know if you had an idea, because I mean, if you're getting your deals done, it's so much stuff going on. You're probably not really getting down to the granular level of that, but I just, wanted to know if you knew.
Yeah, yeah, and I think there's definitely room for improvement. I think we are very passive in our sales process. We don't. I hate to say these words, but we don't hound people. We're like, hey, here's the deal. If you want to invest, invest. And we for the most part, we're not that good at following up. And the reality of any sort of sales process is you have to be very aggressive, and that's just something that's not it's not something I'm used to or something that I really have a background in, nor does my business partner. We're not sales guys, so it's it's something that we need to learn, because at the end of the day, if you look at the best sales teams, they do phone call, voicemail, text, email, follow up, follow up, follow up, follow up, and that's just what you have to do. Ronnie, do you have a take on this?
Yeah, absolutely. Thanks for hosting this discussion. Looking forward to seeing you later this month. I would say you're talking about deals or equity. Which one is more important? I think equity, right? Because you can have all the deal flow in the world, but if you don't have the equity, um, you won't be able to get deals done. I think if you build like a really good warm database, that's how it doesn't matter how many people are on your email list, is how many people actually invest. And I've surveyed a couple of large institutional quality operators, and I asked them, how many active investors do you have, right? And they say anywhere between 2 to 3,000. So if you have 2 to 3,000 active investors, let's just say they put a 500,000 with you a year, it's pretty substantial. Like there's a group out of Dallas, they have 2,000 active investors and they raise 50 million a month from individual high net worth investors. So it's just getting to that number. So I'm like, okay, if I do the math, let's just say I have 10,000 people on my email list and my conversion ratio is around 20%. That's what I need, right? But you have to have the infrastructure in place to support the 2,000 investors. So that's for the individual side. For institutional investors, from what I've seen from the larger groups, they usually have one or two groups they work with and just do it that way. There's some other ones where they have 20 to 30 equity partners, but I think the less is better. And programmatic JV can really change career trajectory if you have the right groups. So that's some of my observations so far. So I'm all about finding the capital first, building those relationships first, and then deals come. Like in the industry, I'm known for raising equity, right? So I have a lot of deal flow from other operating partners that I can it's more handpick. They already have the deal under contract, and we find a way to work together. So that's my take on it.
Yeah, I was gonna say, to add to that, for someone who is looking to get started and build relationships on the equity side, it's that chicken or the egg deal or the equity, right? Oh, how do I raise money if I don't have a deal? How do I get a deal if I don't know if I can raise the money? And I think that's where partnering up can be really beneficial. Like you said, if you have a partner that has a deal tied up, it's their deal, it's their risk on the deal, it's their relationships and reputation and hard money on the deal, but you still have the opportunity to partner, utilize their deal, their experience to sell the deal and bring in investors. That's where I think you can grow faster when you're getting started. And then to your point about kind of growth trajectory later on, equity partners, programmatic JVs are really big and can absolutely grow you very fast. And that's something that we've personally experienced and have been very fortunate with. And it's like, wow, where do we find more of that? The reality is, I don't think you can plan for it. And that's the trouble with it, is you can't just sit around and go, well, I'm going to launch this business and then I'm going to find a programmatic JV equity partner and they're going to fund all my deals. It's happened to people, but I think planning for it is not the right way to go. And that's why this is something that I believe in very much, is there's people out there that they do the institutional equity and they're good at it, and that's how they build their business. And then there's the groups out there that do the retail equity, and they have 2,000 investors, and that's what they are good at. And you don't really see groups that make the crossover. They find their niche and they stick to it. And so I feel really passionate about wanting to be the best sponsor out there that merges both. I think, sure, we can try to be the best institutional sponsor, we can try to be the best retail sponsor, but I think being both is actually really cool and is something that we're striving for.
Yeah, I think if you marry the two, right, you can start off with private capital, individual high net worth investors, build that platform, right, get to 3, 4, 5,000 units. And then what you can do is go to an institutional partner and pretty much recapitalize your entire portfolio. So you cash out your investors, they get a above average return on what you projected. You recap them, you 1031 them into a new portfolio you have under contract, and you're just recycling the equity. Institutions want the big scale. So that's what I've seen with some of the groups I know is they start off with the individual investors and then they recap and move up to the institutional side. So I think that's the way to marry both.
Yeah, speaking of 1031s, I think one of the big benefits of 1031 exchange or of retail investors is that they are more willing to roll over and do a 1031 exchange with you. Whereas institutional investors, they're just usually not set up to do that. It's a fund, they need to return capital. Whereas a retail investor, potentially, if you're doing a good job and providing quality investor relations on top of good returns, you could theoretically raise that money once and keep it forever, because that investor maybe never needs the money back, and you can just go 1031, 1031, 1031. And as a sponsor, that's tremendously valuable, because if you have to do the work of raising the money once, essentially, and you get the benefits of it forever, that's huge, rather than having to raise money over and over and over again. And that's similar to the concept of repeat investors. It's really a shame to put in all this work through the funnel to raise capital and then provide a bad experience, and then they never invest with you again. So that is also something really important when talking about the funnel. So yeah, conversion rates all down the funnel. And I like your point, Ronnie, about if you can get to 2,000 active investors, I mean, that's even a lot. I would say even 1,000. You could pretty much do all the deals you want to do and make as much money as you want. And 1,000 investors is a lot for sure, but it's not that much. You don't need to grow a 50,000 email list to get 1,000 investors. And I think you're probably potentially better at it than most as far as having a higher conversion rate. And I think that's something really interesting to ask people. It's like, yeah, it's maybe exciting to have a big email list, but let's actually talk about conversion rate, or let's talk about somebody who has a small email list, but everyone is an active investor.
Yeah, I agree. As far as like private capital, just from your individual investors, like where are they actually coming from? I found social media to be a really good resource as far as raising equity for us, as well as other GPs actually LP in my deals, which I find flattering. And then another source is just friends and family type of money. Not exactly friends and family, but like it's like within like a certain circle. I don't have like actual friends and family that invest with me much, but I find the LPs that aren't going to the conferences and meetups and stuff, those are actually much higher to convert because they're not on everyone's list. So I actually call those LPs first when I'm doing a raise, do early access to them, get them committed before the webinar, and then go out to raise to the public 506C. What have you seen?
So for us, we do, I'm not sure, maybe a monthly or quarterly audit of leads. And our top lead sources are guest podcasting, LinkedIn, and my book, and also referrals, which is also awesome to see, of course. So big, in the last quarter, we've seen a lot of referrals, which is huge. And then I think social media is vital. So LinkedIn is our social media of choice. And I see other people successful with Facebook. I think you're successful with Facebook. We haven't found any traction, or the algorithm just hasn't really worked for us on Facebook, so we have not really focused on it, but I think everyone can find something that they can work with and stick to.
Yeah, I think LinkedIn is really good for that professional atmosphere, but I've had a lot of success on Facebook. I've literally raised millions of dollars from Facebook. So I can, whenever I come to New York later this month, I'll show you how the algorithms really work and stuff, and all the tricks, because it's been pretty amazing, because like you can do live videos, for example, and it notifies everyone, versus if you post a video, no one's gonna, I'm not gonna get a notification that Rob posted a video, but I'll get a live, right? So, and then the more you interact in the DMs on Facebook definitely helps, and on Instagram as well. As far as like referrals, like how do y'all ask for referrals from y'all's existing LPs, or do they more likely when you have deals out get referrals that way, or what's been the process?
Yeah, we're very passive about it, and I think that's something that we can improve on. I think there's no harm in asking for referrals. So I think people are just doing it on their own, and we're rolling out in an investor referral program right now, which is long overdue, obviously. Where, and again, this is something we're not going to promote. I've seen it promoted. I don't think it's a bad thing, but I think it's just kind of our low key branding that we like. So we're not going to be sending out emails saying, "Hey, if you refer a friend, we'll give you $500." It's just going to be something that happens quietly. So if we see that someone refers someone and that person invests, we're going to send them, a referral fee and a nice handwritten note in the mail, which I think is a good touch. So I think having a program like that encourages it is a no-brainer.
Yeah, I think if you can build a community around your investors, that's like another thing. Like doing like quarterly or yearly events with just Lone Star investors or just Kingly investors. I feel like that helps a lot. And then tell them, hey, invite one or two friends, and just have, instead of it being an open public meetup, which we do meetups here in Dallas, we have 150 people come, right, which is fantastic. But having a more intimate one, I think that definitely helps. And just asking them, hey, bring a friend. And your investors, you are who you surround yourself with. Your investors have friends that want to invest too. So I find that like if you can have like a community sort of feel where it's like an exclusive club, I think that's another thing we're implementing this year.
That's awesome. Yeah, another thing we're implementing in the next couple months is investor days. And similar to what you said, basically it'll be implemented or integrated into my travel schedule. So if I'm going to Miami for a conference, or I'm in Phoenix, or I'm in LA, piggybacking on my travel schedule will be these investor days where we use our database to reach out to investors that we know, or potential investors that we know, that live in the vicinity, and invite them personally. It's not a blast. It's not an email that goes out to 6,000 people saying, "Hey, come to dinner." It's handpicked, personal touch to have these investor days. And the reason why I call it investor day is I'm trying to figure out a way to make it more than just a dinner. I want it to be an activity plus a presentation and a dinner. So something like it could be a little bit of golf or top golf first, and then you have a presentation at dinner, just a quick 30-minute talk, give an update on the state of the market, happenings with our deals, upcoming pipeline, and then just a dinner. So I think I'm probably most excited about rolling this out. It's something I wanted to do for a while, and it's doing something like this where it's not in a meetup style, or it's not in an event where you're selling tickets. It's a bit tougher because it's more expensive. Obviously, you're paying for people's dinners, you're paying for the activities. So I think you need to be certain of your ROI when you start this strategy. But I think we've gotten to this point where it's something that's definitely worthwhile.
Yeah, I think regional, like doing I call it a tour, like I feel like that's like another really good way. Do you know where a majority of your LPs come from, like which city or state?
I know we have plenty in California. We have Texas, and we have New York.
Yeah, surprisingly, a majority of my equity comes from California, which is pretty wild. I've been to California maybe 4 times, so it's pretty interesting. And obviously, Texas, like locally here, but that's like another thing to like figure out is like where does the equity actually come from? Like the retail investors, it's usually like Texas, California, Florida. Pretty much the states we like look into invest are the same places that we get individual LPs from. As far as institutional investors, I found everyone's in New York. I find myself going to New York like every month, meeting with institutional investors. So that's a place to be for the larger equity groups.
Yeah, yeah. I mean, yeah. If I didn't live in New York, if we weren't based in New York, pretty much for sure we'd have raised a 30, 40 million less than we have. But you can't bank on it. You can't just say, well, I'm going to move to New York and then I'm just going to perfectly bump into this right person and then boom, there's the 30 million. It's just, you can't necessarily bank on it, but it has happened. So yeah, it's an interesting point. And yeah, so just
how do you break in?
What's that?
I just had a quick question. How do you break in with New York institutional like equity groups? What I've been doing is literally cold calling. I'm not even kidding. Cold calling and then asking for referrals and different things like that. And it's very hard to land the meeting. So like, if you're not a local group and you're just getting started, like how would you find these equity groups to work with?
So yeah, so it's pretty similar. For me, cold emailing has been very effective. Which actually I gave a presentation at Dan's conference recently, the MFIN conference, about institutional capital, and I talked about my cold email outreach strategy. Also, my upcoming book called Structuring and Raising Debt and Equity for Real Estate. I also talk about the strategy of just cold emailing a group and just basically teasing them with a deal. Hey, this is who I am. This is my company. This is what we do. I have a deal that I think fits your profile. Do you have time this week to chat? And that's kind of my intro. And like I said earlier, if you don't have a deal, this is a bit tougher. Maybe you can kind of bluff it. You can say, hey, well, I don't have it under control. I'm working on it, whatever, but it still works. But for us, we're fortunate enough, and this goes back to marrying the institutional and the retail. We're doing this deal no matter what, right? We're going to raise the retail capital. We're fine, but we'd love to work with you. We'd love to discuss this deal with you. So it gives us the confidence to, one, put the deal under contract because we have the retail equity strategy. And then it also provides us the opportunity to be able to give a live actionable deal to a potential partner, an institutional partner. So that's my simple cold outreach strategy. And then as far as finding them, I also talk about this in my new book, but finding them through conferences, I think is pretty easy. There's conferences, and you don't have to go to the conferences. You just look at the list of attendees and you can kind of filter through that. It's a lot of work, but they're there. These equity groups, they want to be found. They want to do deals with you just as much as you need their equity. So they're just not necessarily good at marketing. So they're a bit harder to find. But if you keep your eye out on LinkedIn, if you keep your eye out on press releases and you read the newspaper or the magazines, the online articles of the space that you're in, which is for us multifamily value add, you can see, oh, this sponsor closed a deal and they had this pref equity partner and this JV equity partner, whatever the case may be, and you can start kind of collecting and seeing that information. And also, another thing is equity brokers. Equity brokers are a great source of institutional capital as well. They don't have a secret sauce to help you get funded, but they do have a list of institutional investors and they can get you meetings right away. Just take a quick pause. Anthony in the chat's asking about creating a newsletter. How do you go about creating one. I mean, this is probably the simplest thing. I'd say from what I've seen, most people are using ActiveCampaign as their email marketing platform. That's what we use. When we first started out, however, we used MailChimp, which is a great free tool. I enjoyed my MailChimp days. And yeah, you can create a newsletter on MailChimp. You can create a sign-up form, which is critical. If you're going to have a newsletter, which you need to have one, you need to have a sign-up form for the newsletter. That way you can collect emails, and like we were discussing earlier, the number of emails on your list isn't everything, but you can't really have investors if you don't have a list. So you need to start building that list. And I remember when I first put my list together, I just basically looked to find every email that I could find in my life. And I got 100 people, 100 person email list together. And then I remember doubling it to 200 and then getting it to 500. And then I think somewhere around there, released the book, gave away the model. And that's another big thing is if you are looking to build your email list, the simplest and easiest way, most effective way is to have a lead magnet, which is where you are giving something of value away in exchange for an email address. People are willing to give their email address if you're going to provide them some value up front. Otherwise, people already get too many emails. They don't have enough rapport with you to just want to get on your email list. It's rare. So if you can give something away for free, like a white paper, a spreadsheet, a video, something that's high value that they are attracted to, that's how you can grow your email list. So we've had well over 5,000 people give us their email in exchange for our underwriting model. So that's been very successful in growing the list. But you have to recognize that the underwriting model is desired by not necessarily my target audience. So if you're building the perfect lead magnet, you want to build a lead magnet that has that targets your target audience. Otherwise, you're just going to build a huge email list, which may not be perfectly applicable for you. So, and that goes back to conversion rates. You can increase your conversion rates if you make things more applicable and also self-filtering. If your sign-up form for a new investor, if it asks, are you accredited? That might filter some people out to not fill it out. And that will increase your conversion rate. You may get less people filling out the form, but it helps your conversion rate. And if you make that form even longer, you say, how much are you interested in investing in? And right. So you can decide and tinker with, do I want to maximize conversion rate or do I want to maximize exposure?
I have a quick question.
Sure.
Oh, okay. Yeah, so my name is Moses Gray. I'm a newer investor here in Chicago. I'm currently working on my first syndicated deal and would love to hear either you or Ronnie kind of speak to your transition going from when you guys first started off up until kind of raising capital in more of a fund structure. Right now I'm working on raising money for this specific deal. Feel like fund structure has its pros and cons, but would love to hear kind of your perspective on how you transitioned going from when you guys first started up until where you're at now.
My perspective on funds is somewhat limited because we've never raised a fund. So I'm not speaking from personal experience when I talk about funds, but from my understanding is funds are a lot harder to raise because you're forcing people to invest in a blind pool, right? They don't know what asset, even if they are a retail investor who is investing on a sponsor first basis and the deal is secondary, without the visual and understanding of the deal and the tangible asset, it just is harder. I would say it's actually interesting. I would say with that being said, there's actually potentially more benefits for the investor to invest in a fund than to the sponsor, because for the investor's sake, they get diversification, and that is huge because it's really hard to be truly diversified when the minimum investment in our space is usually $50,000. That's just also being diversified is tough anyway, because if you are investing in one sponsor in Dallas and another sponsor in Tampa, it's pretty diversified. You've got sponsor diversity, you've got geographic diversity, maybe you can even have strategic diversity, or diversity of strategy, but it's all pretty correlated, and it requires the investor to have more expertise and more relationships to be able to go and get diversification. So diversification is very tough for investors, and so a fund vehicle is potentially a great way to do that, or a fund of funds model also is a great way to do that. If they not partner up, but if they invest in a fund of funds, which is basically a vehicle by which a capital raiser aggregates capital and then goes and invests into other funds or into deals specifically on behalf of the pool of investors, that is tremendously beneficial from a diversification standpoint. So that doesn't necessarily help you on the sponsor side as far as raising money on a deal by deal basis versus a fund, but I would say that I would say stick to deal by deal and worry about the fund later. That's where we're kicking that can way down the road. We just don't see the strategic advantage to want to put ourselves through that difficulty.
Gotcha. And I guess a follow-up question for you, would that answer change at all depending on kind of the size of deals that you're targeting? I know like you're doing deals that are larger equity checks. If I'm focusing on the Chicago market, maybe call it 10 to 30 units, for example. Some of these equity raises are smaller dollar amounts. So it is more of a kind of repetitive process. You'd obviously be kind of getting your reps in and showing investors similar decks over and over again. But just curious if that's a consideration that would kind of change your response for that point.
Yeah, this is a really interesting topic, actually. And I think maybe I have a bit of a unique perspective on this. I think it's less about the deal size and the equity size. I think it's more about deal frequency. So how many deals are you doing per year? Is it 5? Is it 10? Is it 20? Because even if it's 10, that's not that crazy to just raise on a deal by deal basis. You can host a webinar for 10 deals in a year. It's not that much. It's not crazy.
Yep.
And what can happen is if you are doing more deals than that, then what that means is so we have I'd say the most we've ever had going on at the same time is 4 deals. We've had 4 deals happening at once, which is just a ton for us, at least. Hopefully in the future won't be a ton, but that requires a lot of juggling. You're hosting a webinar about this deal, you're closing on the funds on this other deal, and you're pitching multiple deals at once. It's tough. So when you do get to that point where, because you're doing smaller deals of 10 to 30 units, the implication is you should hopefully be doing more of these deals. What you can do instead of going to a fund model is you can just do packages, and you don't necessarily have to do packages based on similarity. Like the deals don't have to be next door to each other to make them a 2-pack and then raise the capital together. You can just do it based on time. If you have 2 deals that you put under contract at the same time, even if they're across town, you can just say, this is the XYZ 2-pack that you're raising money for. And it's basically a mini fund. You're able to give investors the diversification across those 2 deals. And for you, it simplifies your process because now you're hosting one webinar on those 2 deals. You have one fundraising cycle for those 2 deals or 3 deals or what have you. So I think that is the best way to go. And that's something that we 100% plan on doing as we grow and get busier to save us time on the investor relations side.
That's helpful. Thank you.
Penn in the chat is asking a good question about, if capital raising is so difficult, why not always use an equity broker? This is a good point, and I think this is potentially a mistake that people make when they start, is they think, well, an equity broker is just going to save the day for me. I just don't have to work anymore. I just go to the equity broker and they'll find the equity for me. And like I mentioned earlier, I think they're a good source of leads and they can get you meetings, but they're not going to raise the money for you. You still have to be investable. And when I say investable, I mean you have to be worthy of institutional capital, because equity brokers, they have relationships with institutional equity. They're not going to go out and raise retail for you. They're just going to do a Zoom call intro with, some big fund, and leave it up to you to get that done. And so you have to have the track record, experience, infrastructure, reporting capabilities, all that good stuff to raise the money. So I think they're worth using if you want introductions, but you still have to be building towards everything that we're already doing. Cool. Well, this has been definitely a good conversation. Glad that we've been able to make it interactive, which is always my preference. We can stay on and do some more Q&A, but if people want to jump off now, we're approaching the hour, so feel free.
I have a question. As far as reporting requirements, what's the difference as far as like reporting requirements for individual high net worth investors and then the institutional capital you work with? Like, what are some things that the institutional groups ask that usually the retail investors don't really even think about?
Yeah, the thing I like about institutional groups is they ask for what they want. And so most of the time they ask for what they want. And so that is good for you, because now you know what they want and you can just provide it. Sure, it's more work, but at least you're making them happy. And that has made us better for sure over time, working with sophisticated groups that set certain expectations, and we learn from them, and then we translate that to our retail investors as well. Whereas on the investor relations side for retail, no retail investor for the most part is really telling you, oh, I need to see this certain reporting, and they may want it, they may like to see it, but they're not steering the ship for the deal, so to speak. So I think retail investors are just happy to receive decent quarterly reporting. I think why not share the same information to retail investors and institutional investors? We don't really have a difference. We make everything available. Obviously, the vast majority of our investors never look at any of that stuff, but we make the full financial package available with the balance sheet, the P&Ls, the general ledger, all that stuff. I think bottom line, the most important thing that your quarterly reporting has to have is budget versus actuals. And I think more importantly, or more specifically, when referring to budget, is actually your underwriting. You should be comparing your actual performance to your underwriting, because your investors invested with you in part because of your projections, and now you need to benchmark yourself to your projections, and then have commentary and explanations as to why you are exceeding or underperforming those expectations from a revenue and expense perspective, and debt service and all that stuff. So I think, so what we do in our quarterly reporting, we have budget versus actual, as well as underwriting versus actual. The reason why we do that is because our budget is subject to change over time, right? We can get a budget is updated every year, but the underwriting is your underwriting. That was baked when you bought the deal. So we like to compare both.
Yeah, that's pretty helpful. I think definitely with the underwriting, that shows investors like you track that. So I find that pretty important.
Yeah, and it's funny too, because very few people actually do it because they're scared. It's scary to hold yourself accountable to the numbers that you underwrote the deal with, because we're all underwriting deals to win deals. We're underwriting aggressively to be the winning bidder, but then you don't want to underwrite too aggressively and then underperform your numbers later. So I think it's a very fair way to keep everybody honest, and yeah, I think it's really important.
As far as like expectations for LPs, like there's some deep value add deals I see. Hey, cash flow starts next month. I'm like, how? Usually we're like 6 to 9 months out before our first distribution, and we've done both quarterly and monthly. what's your thoughts on investor expectations and then distribution schedule?
Yeah, I think monthly is super worth the hassle. Just the the more times you can put money into your investor's bank account, the better. So monthly distributions is awesome, and it makes a difference. It will be easier to raise money if you offer that. And then your point about when you start distributions, that is, I think, depending on who your investors are. If you have sophisticated investors, they get it. They don't need the cash flow. They're not set up that way to need it or want it, really. They're IRR driven investors. If you're talking about typically more sophisticated or fund based investors. However, on the retail side, retail investors are much more cash flow sensitive. And so I think it does make sense to structure the deal and set it up such that you can provide cash flow as soon as possible. And if you are honest to your investors about using raised funds for distributions, I think that's okay. And it was something I was super against before, but the reality is a lot of people are doing it, and investors want it. And if they want it, give it to them. So that's why I think it depends on who your investors are.
I agree. I think it's setting up the proper expectations. Like a class A deal could cash flow in 3 months, right? But a class C deal, heavy turnaround, may not cash flow for 18 months, even 2 years. So I think if you set up the proper expectations and you could show continuous deal flow on the same type of project, they're going to have the same expectations depending on the deal profile.
Yeah. And different deal profiles are better fits for different types of investors. And that's why it goes back to my point that I feel really strongly about, which is to have a diverse base of investors. You want to have investors that are institutional and they can do the no cash flow deals. You want the retail investors. You want to have deals that can have a mix of both. It's that comes in handy as you want to expand your strategies. And also when you're starting out, I think this is really important to actually have cash flowing deals when you're starting out, because it's maybe not the most sophisticated metric, but if you are able to produce cash flow, the sooner you're able to produce cash flow, the better your investors think the deals are going, and they're more likely to reinvest. Whereas if an investor invests with you and you're not producing any cash flow, and then you go and ask them for more money, they might say, hey, I just want to wait until the first deal I invested in starts producing cash flow, because that's how they're gauging results. So I think if you're starting out and you're trying to build your track record, obviously the faster you can get to a sale, the better. But even sooner than that, the faster you get to cash flow, the better, because then you're more likely to get repeat investors.
I agree. Having the cash flowing deals are pretty important, but setting the expectations is even more important. Because if you can set the proper expectations, hey, cash flow is going to start in Q3 or Q4. It sets the expectation long term, and it's like making sure they have a long term horizon on the deal versus like being a 1 or 2 year horizon.
Right. Yeah. The worst thing you could do is get investors in with the wrong expectations. You definitely don't want that. The other really interesting thing about expectations is if you, let's say, project for year one cash on cash 5%, that's obviously an average for year one of 5%. That could mean that the first quarter is 0%, or let's say 2%. Second quarter is 3%. Third quarter is 6%, and the fourth quarter is 7%, and then that all averages out to 7, or I'm sorry, all averages out to 5. That obviously makes perfectly rational sense, and that is how a deal would normally function, right? You close, you ramp up, you start your value add plan, your cash flows grow. However, from our experience, what we've seen is investors don't like that, and we've had to explain that too many times to where it just doesn't make sense. And it's so what we do is we just smooth it out. We essentially have extra reserves so that way we can effectively borrow from our future cash flows to smooth it out. So that way, if we tell investors it's 5% cash on cash in year one, we're just going to start cranking that out. And even though the performance is like this, the cash flow is going to be like this, which means effectively we're borrowing from the future to smooth it out. Investors hate uncertainty. Everything you can do to provide confidence and certainty, the better. So if you say year one is average cash on cash of 5%, and then your first distribution is annualized at 3%, that does, obviously we could explain it and we all are smart enough to get it, but it's just another thing to have to explain, and you just want to make things as simple and consistent as possible. So that's another thing that we've learned the hard way, you could say, and that we've improved in our process.
So sorry, quick question about for example, if you underwrite a deal and your first year is negative cash flow, but the second year is like double, are you still paying the investor the first year, or how you gonna explain to them, or are you gonna try to average all of these years and like try to come up with the money to pay them for the first year, and then you make up for the second year?
Yeah, it's a good point. We always make sure that we have plenty of reserves for our deals, but then on top of those reserves, we would raise extra cash so that way we could cover at a minimum the negative cash flow for the first year, and then raise a bit extra so that we can provide a nominal distribution for the first year. Even if it's not much, we just want to be able to provide something every month. It can be a tiny distribution, 1.5%, 2%, but we want to be able to provide something every month just because that's what our investors want. And again, like we discussed earlier, that's not every investor. If we're partnering with a more institutional group, that's not necessary.
Got it. Thank you.
Cool. Yep. Thank you for the question, and thanks everyone for sticking around to the end. This is a good discussion. Definitely enjoyed it myself, and yeah, we're pretty much wrapped up here. If you have further questions, feel free to reach out. If you want to get in touch, we are also, as Ronnie mentioned, we're also hosting our annual event in New York, the LSC NY Summit, happening September 19 and 20. VIP is sold out, but you can still grab a general ticket. We'll all be there. Some of my biggest investors will be there, and it'll be a great opportunity to learn with us about state of the market and what investors are looking for in deals and all that. So it's very investor focused, particularly on the institutional side. So looking forward to seeing you there. And yeah, thanks again, and I'll see you on the next webinar.